Welcome back. We now move on to the third and hopefully the shortest of the recordings about tax and trusts. This one covers capital gains tax. There are basically three sort of different situations that I'm going to look at, and the good news is that it doesn't matter what type of trust we're looking at. When we looked at income tax, we said there were rules covering interest in possession trusts and there were different rules covering discretionary trusts. For capital gains tax, good news, we don't need to worry, all trusts are dealt with the same. So, to start with, the creation of a trust, what is happening? Well, if the settlor is alive, it is simply a gift by the settlor. So from the settlor's point of view, you will deem proceeds equal to market value. This, of course, assumes that the asset being put into trust is chargeable to capital gains tax, like shares or property. If the asset going into trust is cash, well, that's exempt from capital gains tax, so you don't need to worry about it at all. Assuming, though, that the asset is chargeable, you deem proceeds equal to market value, work out a gain. Now, because the gift will be an immediately chargeable transfer for inheritance tax, gifts relief will be available to postpone the gain if the settlor wants. If the trust is created on the death of the settlor, well, it's a gift on death and there's no capital gains tax on death. So there will be no capital gains tax implications. The trust will simply receive the asset at a base cost equal to probate value. Once the trust is up and running, if the trust then sells chargeable assets, well, it's a chargeable disposal in exactly the same way as when an individual sells a chargeable asset. So you work out a gain on each disposal in the tax year, proceeds less cost. Then at the end of the tax year, you add up all gains and losses, you take off an annual exempt amount, and in simple terms, a trust gets half the individual's annual exempt amount, and then you pay capital gains tax. Trusts don't get the lower rate of capital gains tax, so most of the time they'll pay capital gains at 20%, although if it's residential property, they'll pay at 28%. The only other thing to watch out for is if the trust makes a capital distribution of an asset, and this is simply a gift by the trust to the beneficiary. So you deal with a gift by a trust exactly the same as you deal with a gift by an individual. You deem proceeds equal to market value, you deduct whatever base cost the trust had in the asset, and if the gain is chargeable, then you sort of go back to my previous bullet. It's like gains on a sale by the trust, and the trustees pay capital gains tax. Do remember, for a lot of trusts though, there'll be relevant property trusts, therefore there'll be an exit charge for inheritance tax, and that therefore means that gifts relief will be available to defer any gain if the trustees want. And from a capital gains tax point of view, in nice and simple terms, that's pretty much all you need to know.